Auditing Theory Chapter 10. Completing the audit. The procedures to wrap up an audit engagement are: review for related party transactions, review for subsequent events, make inquiries of client's legal counsel, obtain a management representation letter, search for unrecorded liabilities, perform final review stage analytical procedure, review adequacy of disclosures using disclosure checklists, the lists of specific disclosures required by GAAP and the SEC, if appropriate, review of working papers, and form an opinion. Related party transactions. Identifying transactions with related parties. The following procedures may identify material transactions with known related parties or indicate the existence of previously known related parties. Number 1. Provide personal performance all segments of the audit with the names of known related parties. 2. Review the minutes of meetings of the Board of Directors and committees. Review filings with SEC and other regulatory agencies. Review conflict of interest statements obtained from clients' management. Review business transacted with major customers, suppliers, borrowers, and lenders for indications of undisclosed relationships. Consider whether unrecognized transactions are occurring, such as receiving or providing accounting, management, or other services at no charge. Review accounting records for large, unusual, or non-recurring transactions or balances, especially those near the end of the period. Review invoices from law firms. Review confirmations of loans receivable and payable for guarantees. Examining identified related party transactions. After identifying related party transactions, an auditor should become satisfied about their purpose, nature, extent, and effect. The following should be considered: obtain an understanding of business purposes of the transactions, examine invoices, executed copies of agreements, contracts, and other documents, determine whether the transactions has been approved by the Board of Directors or other officials, test of reasonableness the compilation of amounts to be disclosed or considered for disclosure. Arrangement for the audits of intercompany balances to be performed as of concurrent dates, even if the fiscal years differ, and for the examination of specified, important, and representative related party transactions by the auditor for each of the parties with approximate exchange of relevant information. Inspect or confirm and obtain satisfaction concerning the transferability and value of the collateral. Events after the balance sheet date. Subsequent events. Events after the balance sheet date are those events, both favorable and unfavorable, that occur between the balance sheet date and date when the financial statements are authorized for issue. The following procedures are typically performed at or near the completion of field work to detect subsequent events. Read the latest available interim financial statements and compare them with the financial statements being reported on. Read the available minutes of meetings of stockholders, directors, and appropriate committees. Assemble pertinent findings resulting from inquiries of legal counsel and other auditing procedures for litigation, claims, and assessments. Obtain a letter of representation from management. When the auditor becomes aware of events which materially affect the financial statements, the auditor should consider whether such events are properly accounted for and adequately disclosed in a financial statement. Inquiries of client's legal counsel. The auditor is required to communicate directly with the client's attorney about liabilities arising from litigation, claims, and assessments. The list of legal issues should be prepared by client's management rather than client's attorney. The information is sent by the auditor to the attorney, requesting information about pending or threatened litigation, claims and assessments, and unasserted claims and assessments. The client should request the attorney to furnish the following information for all pending or threatened litigation, claims, and assessments, and to comment on differences between the attorney's and management's views. A description of the nature of the matter, progress to date, and action the client intends to take. An evaluation of the likelihood of an unfavorable outcome, and estimate, if one can be made, of the amount or range of potential loss. A statement that management's list of pending or threatened claims is complete, or identification of any omissions. The attorney's refusal to pay the audit inquiry is scope limitation that may affect the audit report. In the case of unasserted claims which the client has not disclosed, the lawyer is not required to note them in his or her reply to the auditor. However, the lawyer is generally required to inform the client of the omission and consider in withdrawing if the client fails to inform the auditor. Management representation letter. The representation letter confirms the oral representation given by management to the auditor and reduces the possibility of misunderstanding between the client and the auditor. Reminds management of its primary responsibility for the financial statements and should be addressed to the auditor. The letter should be dated as of the audit report date. Should be signed by the Chief Executive Officer and a Chief Financial Officer. And the representation letter is not a substitute for the application of other necessary auditing procedures. If the management refuses to provide representation that the auditor considers necessary, this constitutes a scope limitation and the auditor should express a qualified opinion or disclaimer of opinion. Written representation requested for management may be limited to matters that are considered either individually or collectively material to the financial statements. Example of management representation letter. This representation letter is provided in connection with your audit of the financial statements of ABC Company for the year ended December 31, 2011 for the purpose of expressing an opinion as to whether the financial statements present fairly in all material respects and financial position of ABC Company as of December 31, 2011 and of the results of its operations and its cash flow for the year, then in accordance with indicate the relevant financial reporting framework. We acknowledge our responsibility for the fair representation of the financial statements in accordance with indicate relevant financial reporting framework. We confirm the best of our knowledge and belief that the following representations include their representations relevant to the entity, such as representations may include there have been no irregularities involving management or employees which have significant role in accounting and internal control systems, or that could have material effect on the financial statements. We have made available to you all books of accounts and supporting documents and all minutes of meetings and shareholders and the board of directors, namely those held March 15, 2011 and September 30, 2010 respectively. We confirm the completeness of the information provided regarding the identification of related parties. The financial statements are free of material misstatements including omissions. The company has complied with all aspects of contractual agreement that could have been material effect on financial statements in the event of non-compliance. There has been no non-compliance with requirements of regulatory authorities that could have material effect on financial statements in the event of non-compliance. The following have been properly recorded and when appropriate adequately disclosed in the financial statements. The identity of and balance and transactions with the related parties, losses arising from sale purchase commitments, agreements and options to buy back assets previously sold assets pledged as collateral. We have no plans or intentions that may materially alter the carrying value of the classification of assets and liabilities reflected in financial statements. We have no plans to abandon lines of products or other plans or intentions that will result in any excess obsolete inventory or no inventory stated at the amount of excess and realizable value. The company Chorva Senior Executive Officer. Evaluation of going concern status. The auditor should evaluate management assessment of entity's ability to continue as a going concern. In evaluating management assessment, the auditor considers the process management followed to make its assessment, the assumption on which the assessment is based, management's plan for future action. When events or conditions have been identified which may cast significant doubt on entity's ability to continue as a going concern, the auditor should review management plans for future actions based on going concern assessment, gather sufficient appropriate audit evidence to confirm or dispel whether or not material uncertainty exists through carrying out procedure considered necessary, including considering the effect of any plans of management and other mitigating factors, and seek written representation from management regarding its plans for future actions. Examples of events or conditions which individually or collectively may cast significant doubt about the going concern assumptions are net liability or net current liability position, fixed-term borrowing approaching maturity without realistic prospect of renewal or repayment, or excessive reliance on short-term borrowings to finance long-term assets, indications of withdrawal of financial support by debtors and other creditors, negative operating cash flows indicated by historical or prospective financial statements, adverse key financial ratios, substantial operating losses or significant deterioration in the value of assets used to generate cash flows, arrears or discontinuance of dividends, inability to pay creditors on due dates, inability to comply with terms of loan agreements, change from credit to cash on delivery transactions with suppliers, inability to obtain financing from essential new product development or other essential investments. For operating, loss of key management personnel without replacement, loss of major market franchise license or principal supplier, labor difficulties or shortages of important supplies, and other non-compliance with capital or other statutory requirements, pending legal or regulatory proceedings against the entity that may, if successful, result in claims that are unlikely to be satisfied, and changes in legislation or government policy expected to adversely affect the entity. Writing a management letter. The auditor writes a management letter for two reasons: to encourage a better relationship between the auditor and management, and to suggest additional tax and management services that the auditor can provide. The management letter is optional and is intended to help the client operate its business more effectively. There is no standard format or approach for writing management letters. The management letter should be developed to meet the style of the auditor and the needs of the client.